Hello and welcome back to my channel. My name is Shreyasi and today we are going to talk about the G7 corporate tax deal. G7 has committed to at least 15% global minimum corporate tax. If that sounds too complicated, I'll simplify it for you and make every concept very clear. First, what is G7? G7 or the Group of Seven is a group of rich developed countries, all of them democracies, consisting of US, UK, France, Germany, Italy, Japan and Canada. What used to happen is that multinational companies would set up local branches in low-tax countries and pay taxes there. Now with this minimum corporate tax, they have to pay taxes in countries where they make sales and derive profits, even if they don't have a physical presence there. I'll explain this with the help of an example. There are countries in the world that are known as tax havens because they have very low taxation rates. We will take Ireland for example because their taxation rate for corporations is 12.5% as opposed to say America with 21%. So it suited multinational companies to declare their profits in Ireland and pay lower tax than declare it in America and pay higher tax, even if they had made their sales in America. So the G7 countries felt like this wasn't fair. You are making profits by selling your products here, yet you are declaring profits in countries with lower tax rates. And with economies of these countries hit hard because of the coronavirus pandemic, they felt like it was time to decide on a corporate tax deal to stop this from happening. According to the G7 deal, what happens is the G7 will make companies pay more tax in the countries where they operate rather than the countries they declare their profits in. And second, they will aim for a global minimum tax rate so as to avoid countries undercutting each other with low tax rates. This is going to apply to multinational companies which have a profit margin over and above 10%. At least 20% of any profits above that will be taxed in countries where they operate. The deal is most likely to affect the biggest multinationals of the world, including Apple, Google, Facebook, Amazon, Nike, etc. Now we will talk about how countries have reacted to it. The USA perspective. USA, under Joe Biden, had been pushing for this deal to happen. They proposed a global minimum tax rate of 15% because Joe Biden plans in part to pay for new infrastructure from increased taxes that global companies will pay. Biden also plans to raise the corporate tax rate from 21 to 28%, and having a 15% minimum tax rate would sort of reduce the huge incentive these companies enjoyed in low-tax nations. 28% doesn't sound so bad when 15% minimum tax rate is going to be there, but 28% sounds bad when some countries are offering 0% tax rates. The China perspective. Currently, China has a 25% corporate tax rate, and Chinese experts have said that this deal could prove to be beneficial for China, for it will discourage Chinese tech companies to move to other countries and pay their taxes in China. However, China will have to factor in for Hong Kong, whose tax concessions make it a tax haven, and what the impact on Hong Kong's economy will be. Now let's talk about the India perspective. India is likely to benefit from this tax deal since India had to slash its tax rates for domestic companies to 22% and to 15% for new domestic manufacturing units to promote growth and investment. The total revenue foregone for the reduction in corporate tax was estimated at Rs 1,45,000 crores. Now with the new deal, India could benefit of billions of dollars owing to its huge market and being able to tax companies who operate here but do not have a physical presence. Also, since India already had a higher rate than the proposed 15%, it does not affect our ability to attract foreign investment. And with other tax havens becoming less lucrative, more investment might flow in because India will not have to compete with low-tax countries. Ireland and other low-tax country perspectives. Ireland has a tax rate of 12.5%, which has encouraged multinationals to invest in the country. Irish policymakers are worried that if the G7 tax deal comes into effect, multinationals would leave Ireland because there would be no special advantage anymore. The finance minister of Ireland said that any agreement will have to meet the needs of small and large countries, developed and developing countries. Which brings me to the real issues in the implementation of this plan. First, every sovereign nation has the right to decide its nation's tax policy. This includes keeping taxes low to attract investment, and many developing countries do use it. A lower tax rate is their means and mechanism to keep the economy going. This deal takes away the right of nations to incentivize companies with lower tax rates. Second, some critics say that the proposed 15% is far too low to make any difference in how tax havens operate. And while G7 is a group of advanced economies and all that is very well, but it somewhere does not represent the growing heft of countries like India, China, Russia and Brazil who have to agree to this deal before anything gets finalized. It will be discussed by G20 countries in July to be held in Venice. The company perspective. Most companies have reacted favorably to the future of increased taxation. However, tech company shares did not seem to reflect the fear of having to pay billions of dollars in increased taxes. This is possibly because low tax nations have to first agree to this deal and get on board, which could take a lot of time, if and when it happens. But if India, China, Russia and Brazil decide to join the G7 countries in the G20 summit in July, it could lead to the overhauling of a tax system critics have called broken for decades. If you liked my video, please hit the like and subscribe button and share it with your family and friends. Comment below if you want more topics like these. I'll be back with another video really soon, so stay tuned. And as always, thanks for watching.